All right, markets finished the day lower again after trying to go higher multiple times. We've had multiple 2% rallies today. One early in the pre-market session, then one during the morning during the regular trading session. Obviously, neither one of them lasted. So, and we actually got a pretty rare signal on the market forecast. I'm going to talk about how rare it is, and when you put it with another signal, with another indicator on that same chart that I show you typically, we don't see that hardly at all. Often, unless we're in like full-on bear market low point, which obviously we're not yet because we haven't even finished our correction. So I'm going to break down just how bearish we are, what the signals are looking like here on kind of a short-term basis. Like, again, not we're still well away from being done with this correction. I've been showing you that. I'll show you some charts again. So we're still but in the short term. Again, considering that we're still pretty much in the range of the past few days, we're setting up for a pretty decent move that we've seen before, right, to the upside toward those moving averages. So we'll talk about that in today's video. We'll talk about the shoes that are finally falling, that now kind of confirms the correction on the broader market. Now the Russell has corrected, has gone all the way through its 200-week moving average. Now the other end of the risk scale is starting to come down with it. So I'm going to show you which shoes have finally fallen there and what that means. And we'll take a look at a trade idea in that segment of the risk scale and talk about how to trade it. So let's go ahead and get started. Today is Wednesday, May the 11th, 2022. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's start off taking a look at the market forecast here. We got three clusters in a row. Down 9% below the moving average. So again, it's pretty rare to get multiple clusters like this in a row. Let's go back. Let's just go back at the 20 years, all the way through that last bear market. The last bear market that we've had, the 07, 08 bear market. So you can come here, you can see we got three clusters over here, but every cluster produced a short-term bounce. So we never got a cluster of them. This was the day that we got. This is the last time that we got a cluster of, in this case, 6 in a row. You can see we got 1, 2, 3, 4, 5, 6. We started off only down 5.6% below. By the time we got to the 5th cluster, we were down about 9% below the 30-day moving average. Going into expiration, then we had the one last one. And then 2 days later, we were right back. We had to erase those 2 down days. So just like that, you can see how that played out. Again, you can see no clusters here. You got 2 clusters in a row there. And in 2016, that led to a bounce. One there in 2012. Another one here in, 2015. Another one there in summer 2015. And you can see you just don't get. You got 5 out of 6 there in 2012. But again, you can see we were only 4%, less than 5% below the moving average at that point. You had 4 clusters in a row there in 2012, and again we were only 5% below instead of, remember, we're 9% below now. But you can see how rare it is to get more than 2 in a row. Typically you just get 1 or 2. Here is the very end of the bear market, and we were 9% below. Now I don't think we're at the end of a bear market, because again, even if you go back to 2018. If you look at how high the VIX is now compared to then, back at this was the last time we had multiple clusters in a row. We had 6 in a row starting on the 17th. That was our first cluster day. We were at 24 on the VIX. We're at 32 now on the VIX. We were only at 24 there, but we were over 100%. We finished at 105%. By the time we had to 4, 5, and 6, you can see we were closing 112, 115, 125%. Above VXV. We're not even at 100%. We're not even at 97%. Like we are, the VIX is not high. It's higher than it was then, right? Eventually it got to, on an absolute basis, eventually we did get up to 36, right? On the last cluster, we're at 30. So we were higher now than the first 5 clusters we got there. And on that 5th cluster, again, we closed at 115%. We're right here right now. This is where we're at right now, where my cursor is here on the current, where VIX is relative to VXV, which means VXV, which measures, or VIX3M, which measures long-term volatility, is higher now than it was there. And this is what I tweeted out earlier today. If you look at VXV here on this chart, all those other times that all these other market declines, and we'll go about these market corrections. Obviously, COVID, you had a big spike. There's the first quarter of 2018. There's the second quarter. This is where the MACD is right now, a normalized MACD, the PPO. I mean, all of these other, there's 2015 and 16, all these other instances had spikes in volatility that we're just not getting now. We had a couple over here, but we are higher now than we were in 2018 and 15 and 16. We are higher net. We are about as high now as we were in 2011. And you can see we had a spike to get here in 2011, a big spike of 12, 15%. We never did get, we got the 10% initially before when we changed things around. But we're just on this kind of slow and steady bullish volatility regime to the upside. And it's not, we're not capitulating here. As bearish as it seems, multiple clusters, the expectation of a short-term bounce probably up towards 4,200, probably won't get above 4,200. Maybe you won't even get above this 4135 area, this where these 23% lines are. But you've got some pretty strong support here in this area between the green and the orange 38% lines, this old low point, the old 23% retracement of the post-COVID rally that we were holding for support, that we finally broke through here a week ago. Like, that's going to be our limits to the upside in any short-term bounce that we would widely expect to get. That's the S&P. Of course, you look at the NASDAQ and you can see very same thing, lots of clusters. We've got 4 clusters in a row on the NASDAQ. And this one does tend to get more because it tends to be more volatile than the S&P. But you can kind of see again, well, most likely any rally we'll get will be up to this 13,000 area. Probably nothing more than that. Again, 4 clusters in a row, 12% below. And then you look at the Russell 2000 and the same thing, you just have to keep activating these to go down to new lows of where we're currently at right now. The Russell's at its 50% retracement of its post-COVID rally. Remember, we just barely broke the 38% retracement on the NASDAQ and the Russell, and we just barely broke the 23% retracement up here of the S&P. See, this is where the S&P's at right now, right in this area. So again, that's why I think we'll have a short-term rally back up to that line, just like the Russell did when it broke the 23% retracement. Here is the COVID move. You can see the big jump higher, and now we're lower. Now we got the dark pink shading and the red line, and we are well below, not COVID below, but we are well below the 30-day moving average right now, further below than any other time. This is the last time we had multiple clusters in a row on the Russell. Figured out a low point eventually and had some. The intermediate line got up to the 40, got up to the top of bearish territory. Actually got up to just barely above 50, and then made its way up to a cluster. I mean, can you believe that we got an overbought cluster just over a month ago? We had an overbought cluster, and now we are at multiple oversold clusters, and that far down below. It's just crazy, the kind of market environment we're in right now. Of course, you're getting a bearish candle in the Hakinyashi. We are currently closing below the prior week's low. Again, the size of those candles are getting pretty big. Doesn't mean they're about to go up. It just means they'll probably start getting smaller bearish candles there. The PPO is falling down 2.5%. We talked about that in our last video. If you look at the market forecast on the weekly chart, you can see again we're getting a cluster on the S&P. We got the cluster on the NASDAQ last week, so this would be the second cluster on the NASDAQ. And then the Russell 2000 is going on its 3rd weekly cluster in a row. So needless to say, even on a weekly basis, and we're 12% below the 30-week moving average, which is a really low level. That's about how low we got over here when we got that cluster in 2018. So again, I expect that we will bounce up here, if not by the end of the week into next week. We are getting some very, very oversold levels. But 2018, we did eventually just go through. I don't think we're going through this time. I think we're going to hit some pretty steady resistance in this area before we roll over and finish the correction, right? And that's kind of goes over here. You can see we are below the 200-day. The 30-day crossed back below the 50. The 8 and 17-day are dropping. We're sharply lower. The MACD is as low as it's been all year long. But the MACD histogram hasn't peaked. The histogram's got to peak first before the MACD itself peaks. At the very least, they peak together. So that hasn't happened yet. So that means we're probably not going to get a bounce up yet. And if we do, we'll probably still kind of get slow grinds to the downside as that MACD rolls around, the histogram rolls around. That's what we're seeing on that chart. But if you look at the weekly version, you can see that we're still only about halfway through. Remember, the Russell 2000 has gone all the way down to the 200 week and it's now past it. And we're sitting on that 50% retracement, and the 62% retracement's got the point of control for the last, 5 years. So IWM has passed it. Apple is just barely broken the 50. So Apple has just barely started to correct. And that we talked about, that was one of the last shoes to fall. If you follow me on Twitter, I posted multiple shoes that still have to fall before the correction ends. This was one of them. Apple starting its correction, because it hadn't started before this last, dropped 5% today. So it hadn't started prior to this. Now, depending upon how we finish the week, and most likely we'll finish here, the MACD is more negative than it's been. See, we never did correct on Apple during COVID. We came right back up immediately. But we were further above the 50 then. The MACD was a lot higher when it dropped. Not as high now. When it kind of a head and shoulders top. More likely, it's in not very much volume here either. More than likely, it's going to have, quite the, it has a lot of potential to correct to the downside. Looking at some of these other oscillators, they're still in bearish trending mode. We're above 25. We're not extreme. We're not extreme on SPY. We're not extreme yet on the Qs, and we're not extreme on IWM either. So it's almost like death by 1,000 cuts. We're just slowly grinding in this very mature trend. We're well above 80. We're well below -5 now. You look at IWM's the same thing. The Qs are the same thing. This is a very, very mature trend that we're just kind of starting, and you can see kind of what happened over here. It's very similar here, but we did rally back up to the blue line even. I don't think we'll get all the way to the blue line, but we rallied all the way back to the blue line within a few days before we peaked and continued lower. We're well below the green shading here. That was this bullish rally. We're back below that green shading. Well, we're not anywhere near any kind of end to this correction. Looking at the RSI and the CCI, we're still in bearish levels. We're in bearish levels on the weekly chart. Right? We're dropping below 40 and well below -100 on the weekly. It's the same thing for the NASDAQ. Very bearish. In fact, the NASDAQ's weekly RSI is below 30, and then the Russell, you can see, has been below 30, and there's below 26. So very, very short term. You can see it was the end of 2018. Very similar type of week. We might be getting that type of week. It's not going to be a capitulation week though, because we're still missing the 125% level, which means VXV is still too high for us to be the capitulation. Capitulation means there is more fear about what's going to happen tomorrow than there is in the next few months, right? Everybody thinks we're so bearish now that 3 months from now we're going to be higher than we are here very easily, right? Because we're more worried about what's going to happen right now. That's not what the VXV is actually higher than the VIX is, which means people are still more concerned about 3 months from now than they are about tomorrow or the next 30 days. And that says a lot about what kind of market we're in. We're not capitulating. We're in a bearish trend, and we're just steadily moving higher in this volatility. You can see, the VIX is getting well above its 200-day moving average. Not extreme though. Like again, you look down here, you say, okay, how far is the VIX above its 200-day simple moving average? It's pretty high. It's not back below its moving average yet, but it's still pretty darn high there. And it looks to be like the MACD histogram is rolling over, like we are kind of steadying the ship on the VIX. If you look at the weekly version, however, though, how far above? We're not that far above the 200 week. You can see, like in 2018, when we finally went parabolic at the end, we were well above the 200. We were 100% above basically, it was double what the 200 price was. Same thing in early, we were about 100% above that. In early 2018, that wasn't even a correction. Then you go out to like 15 and 16, you can see we were at about 90%. Remember, we're 54. And then 2011, we had started so far below it, well below the 200 by the time we peaked. So we really only got about 60% above. In this case, we're actually starting just slightly below it. Similar levels as where we were at the low point in 2011 at that 15 level, but that was one big spike. This has not been a spike. This has been a gradual move that we're just continuing to gradually move higher. You look at the 4-week range, you still got that gap to fill. That's why I still think we're headed up towards 413, if not 418, by either the end of this week or the end of next week. Probably more towards the end of next week. Lower high, lower low. We did close below yesterday's low, so we still got a bearish candle. We got to stop that before we do turn it around. But you can, again, you can see the Arun indicator here is what we look at for this chart. That the green line, the red line, still easily well above 70. We haven't really hit a low point yet until it falls down and the green line starts to rally up. But that's when you know that you've kind of hit that low point, when this red line starts to fall. We've hit that low and bounce, and the red line's falling. The red line's not falling. This is the 4-week low still. We got to get off of that 4-week low, and the green line's got to move its way up above this 30 level and stay there. So that's what's going on with the Arun. The same thing with the stochastic. Sometimes I show you this in chart 2. Again, we are very bearish on that orange line. It is so rare for the orange line to get below. It did in COVID. At the lowest point of COVID, it got below. It did not get below in 18. It did not get below in 16 and all these other corrections. It did not get below in it didn't even get below the very beginning of 2008, that correction that started that bear market. There's 2011. It did get below previously and then right at it. 2012, it got below it twice. That's what prompted QE3. And then the early 2008 correction, we barely got below. By the time we were in bear market, it stayed down. So that's very bearish. So until we close high above that moving average and start turning it higher, and especially start closing up here in the upper half of the range. See, last time we closed in the upper half of the range was there. We haven't closed above that 75th percentile, the upper quartile, for quite a while. We've been down here, so that's got to change too before we find an intermediate low point. At least we got to get above that orange line for that to happen. So that's all the different oscillators. Let's look at the Bollinger Bands one more time. So we are still in the lower quartile. When you look at the bands and the Keltner channels together, we're still below the lower Keltner channel. So as long as you're in between those two, but you can see the Bollinger Bandwidth is pretty darn high. It's not the highest it's been, but it's higher than it's about as high as it gets during a normal correction, right? COVID, barring COVID, and as bearish as that was, the momentum is still bearish. It's still red, so it needs to turn yellow before we turn this ship around too, and that hasn't happened yet. But the bandwidth is really high, so and that stochastic orange line's really low. Like, this is extreme. We are getting some pretty darn extreme levels here on these charts that would suggest that this is a week that we may be kind of peaking in the bearish momentum, at least in the short term. Maybe for this kind of a rally, because you are getting multiple. I mean, we weren't as down as much today, but we've had 2-3% drops, and we haven't had a single rally of 2% or higher since. This 3% drop, we did get a 3%. We got a 3-day winning streak that culminated with a 3% rally. So expect a 2% or more rally here. Again, if not by the end of this week, really quickly. I mean, we're getting pretty decent intraday moves to the upside, and especially overnight. And that's the problem, is most of these intraday moves are actually coming overnight. And it needs to not come overnight, but come in the mornings after the market closes. So when you look at the moves, you can see here, we had a pretty decent move off of that low point up to the high point. That was a move from that low up to this high point. you're looking at about a 2.5% rally overnight. Over here, you had from that low to that high a 2.6% rally. So we're getting, right here earlier this morning, or right after the open, when we dropped after the open and then we rallied, we had a 2.5% rally this morning after the market opened, immediately after the market opened, before pulling back by the end of the day. So the rallies are there. This little short-term rally in the middle of the day yesterday got up to 2.13%. So lots of 2% intraday moves, but very short term, and they're sold off pretty quickly during the regular trading session. And then the other two are occurring overnight, and we need it not to occur overnight. We would prefer like a 1% drop overnight, and then we can get that good sustainable rally in the mornings, like in the regular trading session. That's what will make it more sustainable. So if we get a 2% rally tonight, 1.5–2% rally tonight, then expect the same pattern. If we get like a 1% drop tonight, then look for that 2% rally or 3% rally to occur from the open, or after we form the intraday low early in the morning there. And again, I've already shown you the VIX, but again, the VIX is hardly capitulating. But you also notice that the VIX, we got this pattern yesterday where we opened above 100% and closed below 100. So we have multiple of those. It got above 105 back here. Again, that kind of pattern typically marks a top in volatility on an absolute basis. So I don't think we'll fall too far. It'll probably come down to 90%. Depends on how much VXV drops, which doesn't seem like it's going to be dropping very much. But it does appear like I expect that we're kind of forming a little bit of a top here. And volatility will start to pull back again, like I said, if not by the end of this week, into next week. So what do you think? Which is options expiration week, right? And that could really mess people up if we get a pretty decent sized move one way or the other going into next Friday. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that would suggest why you're either a lot more bullish than I am or a lot more bearish than I am? All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen, hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. One, you liked the video today. Two, you want us to do another video again tomorrow. It's a quick way to give us feedback if you like our stuff. Of course, if you don't like our stuff, you don't have to click on anything. Also, while you're down there, comment. What stood out to you from today's video? What questions or comments do you have? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things here on the right. Click on this icon. That takes you to our Market Outlook live page. On Monday, Wednesday, and Fridays, I do a Market Outlook live video on this page at 3:30 Eastern Time. It takes about 10–15 minutes. I look at all the trades that I've shown you in other Market Outlook videos, the ones that I told you, that we've looked at getting in. We talk about whether we should stay in them or get out of them. In fact, we got out of multiple former Market Outlook trades today. In today's video, you can see that here. We also put on today's trade idea before the market, the one that you'll hear at the end of the video. We already put it on today before the market closed. We did that during this as well. If you come down here, you can see our upcoming classes. Click on View More. You get to our calendar. You can see all of our upcoming classes here and all recorded classes going back 4 years back on the calendar there. Come down here to the bottom, click on that heart. It opens up this tab, hit that like button. Same thing here, click the thumbs up icon, takes you to this tab, hit that like button. Again, the more you do that, the more you like our content, the more you comment, the more you share it. It helps get our content out to more of our followers because of how their algorithms work. That's why we always ask. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. All right, now let's take a look at what's driving the price action. And here's the moves of the last 3 months. You can see commodities had a really good day today, and they're still holding up some really good 3-month returns. The dollar is very strong, along with gold. Gold pulling back, but up today. Not surprising. Today was obviously a very risk-off day, despite the lack of capitulation there from a volatility standpoint. But it's not too common to see commodities up, and when you're selling off from a risk standpoint. But bonds finally had their day. They haven't had very many good days here. And you can see the Qs are down 3%, IWM down 2.5%, large caps down 1.5%, international equities really outpacing US. That's going to be the case going forward right now. If you take a look at if I look at international equities, let's look at US equities relative to international equities here on the daily chart. You can see we're breaking down finally because it's been so bullish for so many years. I mean, you look at like the 5-year version of this chart. We've been so bullish for so many years. So we're finally kind of rolling over there. We had a little bit of a rollover at the beginning of the year, and we're doing it again now. You can see we're below the 8 and 17 day. They're both down below the 50. The 30 days about to cross below. The RSI is trying to get below 40. We haven't broken the 200-day moving average yet. The MACD is down. The PPO is there. Let's take a look at the daily PPO. This long-term PPO, you can see we are below its moving average, but we're not below the 200-day yet. So that's when you're in this bearish divergence. We had that over here. We had the PPO was down below its moving average, but we never got below the 200-day. We just barely there a couple times to turn right back up there. So it remains to be seen whether or not the MACD is just turning negative, still pointed lower. But there's no see over here you had a pretty decent bearish move. The ADX rallied. The ADX is actually still falling below 15, so we haven't really broken out to a new trend yet on this. But you can see how it's susceptible to that for again, like I said, international stocks to really outpace equities. We've been looking at some of these others, like one of the shoes to fall is this ratio. Remember how that ratio had not fallen yet? The high yield relative to investment grade. Well, look what's happening. High yield is breaking. Finally, it's breaking relative to investment grade. Every other risk-on relationship had broken, but this one hadn't. In fact, it hit while the risk appetite was waning. This was actually rallying. But that's not the case anymore. It's really catching down to the downside pretty sharply. You can see the MACD is falling sharply. The PPO is rolling over, about to cross over. So I think you're getting it. This tells us we're just barely starting a risk-off move from that perspective. Of course, when you look at like high yield relative to IEI, right? So treasury, the equivalent treasuries, you can see we are breaking down. We have to look at a 5-year weekly on this one, since we are obviously a lot more bearish. Let's go to the weekly PPO down there. So you can see we are just kind of, again, just starting, right? We're just starting a correction between the 50 and the 200, and you can see what the others look like. The COVID got way down there, and then if you look at LQD relative to IEF, right? So that's the investment grade portion of it. We are below the 200 week, so we are starting. That we did have a correction. We have had a failed correction bounce. We are starting a bear market from a bond standpoint, corporate relative to the equivalent treasury bond. And you can see the PPO is still dropping. The MACD is negative. We still haven't really even started the trend yet on this. We've had some pretty decent bearish moves, but the ADX hasn't gotten up, not like it did back here during the COVID, or back here when we were really bullish going into 2018 when we were really parabolic there to the upside. So you can see how things, these risk relationships are really turning in bonds. If you look at TLT by itself, here, let me pull up this chart. If you look at how TLT has been so bearish, right? Well, the last 3 days it's been pretty bullish. You got the engulfing pattern 3 days ago, and then another engulfing pattern today. The MACD is above its moving average. We're not above the 17-day yet, though, so keep that in mind. But, again, a better bullish day than we've seen in a while. In fact, if you look at the daily change here and pull up TLT, we haven't had a big day like this since April the 20th, where we had a 2% move. So almost a 2% rally here, coming off of that 2% drop that we had just a few days ago. This one's a little different. If you see this 2% move, you can see we actually gapped up more than one standard deviation down at the bottom down there. This one we actually gapped up a little bit less than one standard deviation, and that one we were well above one standard deviation down at the bottom. Well, this day we actually gapped down more than one standard deviation and then rallied up 2%. So that kind of makes it a little bit more significant of a move from that perspective. So pretty significant move for TLT. You can also see too, if I were to go back to this chart, you can also see gold is rallying, US dollars rallying, and like I said, everything else just off to the downside. One other kind of risk asset class, we talked about Apple and how that shoe is falling, but you can see Bitcoin's really close to breaking a very significant level. It did on the intraday. We got down to 28,000 at the low there. We're kind of, trading, kind of flirting around with that. If you look at it on the 1-day chart, it appears to be that's where we're at right now. In the after hours, we stopped at 29,000. Trading at 29,000 is important, really important, because if we break this level, if I were to go out to that 5-year weekly chart here, if we break that level, then we are headed down towards the 200-week moving average, if not lower. I expect it will actually be to this 18,000. I think it will actually come down towards 12,000. We'll get a pretty steep, again, very similar to ARK, because I kind of put those two together. ARK got down to its 200-week and just kept going. One little brief rally to the 8-week, but just kept going, is now all the way down to 37 with a really, really low MACD divergence on the histogram setting up. Coming off a really high MACD, about 10%. So we just flip the script and a lot of volume. This is what a capitulation looks like. We're still 2 days away and the volume's already way up there. So big spot, big average range relative to where we're at. So if you look at the average range here for ARK investments, way up at 10% of price. When you look at the weekly version of this, 24%. The ATR is at 24% of price, 9 points. And then to this week's range is 8.3. So we're right there, just about right at the average, which is very, very high. And you saw the volume is extreme right now. So very extreme amounts of volume. That's what a capitulation looks like, right? This, we're not quite there. I mean, we're above average, but we're not quite there. And we're getting a pretty decent range this week. It's above average. But that, but keep in mind what that average is. When you look at that average here and put it on the weekly version, we are at 4%. That's relatively high, but it's not crazy high like ARK Investments. So ARK Investments is more than double that right now. The ATR right now is 17 as we pull back there. But you saw the daily version. The range today was 12 points on today's range, well above the 10.5 point average. And then you saw the volume too was well above the average coming off there, and we're above this 2.5% mark. So again, another one of those extremes, but not extreme to where I'm Tom Lee and we're gonna just go up from here. No, at the very best, we're probably something like this, and that's probably all we get, right? Just to move up, just to get the near term, up to these moving averages, up to those Fibonacci levels, like I mentioned, up probably up to this area, 4,200 at best, maybe up to 4,250. But just get up into this Fibonacci retracement areas, get the near term line up into bullish territory, but I don't think it will stay there very long. Definitely not as long as that one. Probably just, again, probably more like this is the type of move that we'll get up into this area here. And that will be it, right? And then we'll come back down to these levels just a lot slower. So again, because the VIX is not capitulated, it'll be slower and it'll feel like, again, a slow death by 1,000 cuts, so to speak. Let's take a look at the sector moves. And you can see the comparison here. And let's look at today's sector rally. Here is May the 11th. All right, you can see, again, discretionary and technology, communication services, your big winners. And it's really those big mega cap names are finally rolling over, whether it's Apple, as I shared with you there, finally starting to correct, right? So there was Apple breaking that 50 and breaking the 23% retracement. Tesla breaking the 50, it's got the 23% retracement is, you can kind of see it's breaking the 38% retracement there. Here, let's get rid of these lines. Remove that one and remove this one. So there's your 38% retracement, but you can see barely breaking the 50 for the first week. Microsoft, the other one that's just barely started to correct in the last few weeks. It's now breaking below all these lows. So, I mean, you finally got the bellwethers that are in correction mode. And that was from one of the last shoes to fall. Of course, you need bonds. We don't have a correction without bonds rallying. And if this week's gain can hold and we get this super engulfing pattern, then we are going to rally. We'll probably rally back up towards 135 would be my guess on TLT. But you would expect a rally there back above the 17 week and back up towards at least that old low point. I don't think you're still in bear market, but at least you'd get a remove up probably through that support and then start to trade between like that low point and that high point. Try stay in this. You will probably trade right around the point of control for however long it takes before it starts a bull market again. And that's got to start before we start a bullish rally in equities again. So our trade idea of the day is an old school tech, large cap tech bellwether, and it's Qualcomm. Qualcomm has been bearish too, just like everything else. It made a failed bullish run, intermediate run out of bearish territory, but couldn't stick. And now we almost got a cluster today. We were that close, 21.51 would have been with the market sentiment line. Very strong bearish trend going on right now. On Qualcomm, you can see the PPO is as low as it was during COVID, except the difference is during COVID, we had really big bearish candles. We're not getting really big bearish candles. In fact, we're back to getting bearish. We just started a bearish candle after getting that transition, 2 weeks of transition candles there. Again, a failed attempt at going to the upside. So it's trying to get going here on a new move to the downside. You can see some of the oscillators. See, there's this isn't a strong bearish trend. In fact, it's kind of no trend at all with the ADX as low as it is. But the positive indicator is pretty darn low. So you're kind of set up for a breakout move on this stock to the downside, especially if, again, it follows the same pattern, getting below the point of control, getting into the lower quartile of the chart, and the bandwidth's not very high. So it's kind of following the same pattern as these other mega cap names. So what I decided to do here on this stock was say, okay, well, let's go out to June and let's be pretty aggressive and sell the 110 by the 115. If you take a look at that chart again, one standard deviation is down to 108. That's one standard deviation. And keep in mind that if we do get down into this area, there's no volume here. Here, let me go weekly. There's no volume here. So if we get down to 108, there's nothing to hold it up till you get to well below 100. We went so fast in 2020 up through here that it's going to be very easy to drop, especially if you get below this 125 level, that 50% retracement with the last few touches to the downside were. So we went pretty aggressive with the bear put spread, selling the 110, buying the 115. This is what it looks like. So I don't have a lot of flexibility, but I also have very low risk. Here, there we go. I got very low risk, about a 4-to-1 reward to risk ratio ultimately if it plays out. Just in the next however many 6 weeks or so until June expiration. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment down on the video below. Also, hit like us on Twitter and Facebook. Join our website at marketscholars.com for free, as I showed you earlier. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.